So this week we got that interesting news, which we kind of all thought would happen. The Fed has raised the interest rate. What does this mean? Well, what this primarily means, especially to consumers, is that you're going to see the cost of loans and borrowing start to rise. And like I mentioned in my last couple of videos, this was pretty much expected for the Fed to come out and try and taper. Taper in the sense that the Fed is trying to combat inflation. As inflation jumps up, the Fed will use the interest rate to really fight against it. Being that inflation is running really hot, last readings are around 7.5 to 8%, right? That's that core number that shows how prices of goods and services are increasing over time. And so as the Fed looks to raise the interest rate, it in hopes of restricting borrowing so that essentially things cool down. That is their ultimate goal. And so what does that mean for you as the consumer, and how does that look like for the economy and just things in general going forward? Well, let's take a look. So the Fed's fund rate is the overnight rate that banks can essentially lend to each other. It allows the banks to borrow as need be if they're short on deposits. There's really a lot more to it than that, but the idea is that as you raise interest rates, you are essentially not allowing businesses or banks to lend as freely because it's essentially getting more expensive. And when things get more expensive to lend, that's most likely not going to happen as much. Now, it was only, like I said, 0.25%. So it's a very small rise in the interest rate. And the Fed has actually come out and said as much that they're looking to raise rates throughout the year. And so we may see a full 1% come out through 2022, which would be their way again of trying to fight inflation and restrict some of the loans. But again, primarily, what does this mean for you as the consumer? So firstly, the biggest thing that happens is everything that gets affected are our consumer loans. Most importantly, credit cards. Not that it matters to most of you who are paying off your credit cards every single month, so you're down through zero balance. But you'll start to see some of that debt, the cost of having that debt go up. Private student loans, if you're not paying a fixed interest rate on student loans, if you're paying a variable rate, those will definitely go up because they all are, again, tied in. Car loans, right? So everything, again, is influenced by the Fed's fund rate, and that's what they base a lot of the interest rates off of. So you'll start to see car loans start to go up in terms of the cost for those things. Now, mortgage rates are the tricky one. Mortgage rates don't necessarily follow the Fed's fund rate. Instead, they follow the 10-year. However, in most cases, as the Fed funds rate is increasing, all those are increasing as well. And so you'll see the 30-year mortgage start to creep up along with any of the other terms, like a 20-year or a 15-year. All of those will slowly start to come back up as they're trying to again, track the Fed's fund rate. And so you see this idea, again, of as things are getting more expensive to go out and start buying, and especially as the Fed keeps raising the rates, those values are going to go higher, right? A mortgage that's maybe 4% now will most likely keep going up as the Fed raises interest rates. So it could be going a lot higher. So keep that in mind going forward on some of those purchases, right? I think the biggest thing is purchases around car, purchases around a house. Even though prices for some of those things have gotten exorbitant because of supply chain issues, the interest rate may have another effect on how much you're paying for stuff. And hopefully over time that should bring down the cost for these things because people start to realize, hey, if I'm going to pay now 5% on that house or 5% on that car, maybe I can't afford as much. And so maybe that'll start to bring down some of the pricing. And that's what the Fed is hoping for, right? It's as inflation has kind of ramped all these things up, aka house prices, car prices, hopefully that should start to slow some things down. One of the byproducts of increasing the Fed's fund rate will also increase the interest rates that are offered through savings accounts. And so, like this article is going on to describe that some of the larger banks, such as like a Wells Fargo, U.S. Bank, Bank of America, those savings accounts that you hold, those aren't likely to increase. Those interest rates that they're giving you, the savings rates that they're giving you at the 0.02% interest aren't likely to go up. However, some of the banks that I've described, such as an Ally Bank, some of the credit unions, some of those types of banks that offer online banking don't have branches necessarily and can offer higher interest rates will most likely start raising some of their savings rates. I know Ally was at, I think, 0.5, half of 1% throughout some of last year and into this year. And so that rate will most likely go up. So that's a good sign for us as consumers, is that if we have a lot of cash kind of sitting on the sidelines, even though we're getting beat up by inflation, hopefully through some of the raising of the interest rates, it'll help to keep some of our cash growing at some marginal pace. And so be on the lookout for that some of those rates will most likely go up. So remember, all these things are connected, and that's really the hope and the goal of the Fed. And we think maybe they moved a little too late, as the Fed's fund rate has been so low since basically the pandemic, which was March of 2020 at this point. It's basically next to nothing. And remember, the Fed has the ability to lower the interest rate, which would then create ease of lending and hopefully spurn the economy on. And so at this point, they're trying to essentially cool down inflation so that it doesn't get so out of whack like we saw in the late 70s, right? 14, 15%, that they're trying to at least manage not only inflation, but some of the supply chain issues that are still kind of running throughout. And you'll see that in this article that, again, I have here through, this is actually a New York Times article talking about how, supply chain disruptions could basically prolong rapid inflation. And the really cool thing, which we wanted to go through shortly, was this inflation and the Fed's fund rate. So you can see right here, this little blue line is the Fed funds rate. And it's got a timeline all the way, this one goes back until 1998. And it's showing the inverse relationship between the funds rate and this is core CPI, what we would call inflation, right? So as they've raised interest rates, inflation kind of trails it a little bit, but you see things start to come down, right? So as the Fed funds rate goes up, the inflation starts to slowly take a dive, right? And vice versa. So you see here, this dark blue line is the core CPI, and this is the Feb reading of they say 6.42. I think it's a little higher than that, but and this is where the Fed's fund rate is, right? And basically next to nothing. And so again, at some point, they had to do this. They had to raise rates, and we see them looking to do so not only this month, but coming throughout the year. So again, if their goal is to get up to 1%, then we should see that start to climb up here pretty quickly. And so hopefully, as some of the supply chain gets worked out through COVID, and it may or may not, depending on how fast some of these things get caught up, especially through some of the war that's raging on, although that shouldn't be a super drastic effect on most of those exporters, and especially us as the importers. But it all kind of remains to be seen. One of the other big things was you saw some of the, well, maybe you didn't see, but the reaction from the market yesterday, it kind of took a really nice bounce up because of, we think, a lot of the information that the Fed basically came out and talked about. They are trying to be accommodative, of course. That's always their goal, is to lower inflation, keep unemployment relatively stable around 4%. Their inflation goal is 2%. And so Jerome Powell came out and was talking about how they want to be accommodative. They didn't think that the supply chain was transitory anymore, which is what I wrote about in that email. And so you should start to see the market react in that way because of the Fed coming out saying, hey, we're trying to do everything we can to make sure things don't get crazy, and to make sure we don't cause any kind of recession, or to make sure that we don't cause basically asset bubbles to form. So that was the big news for this week around the Fed. And again, what does that mean for you as the consumer? Well, think about all your loans. Think about any debt that you're taking out, whether it's mortgage, car, credit card. those costs will start to go up. And think about the savings rate you're holding in the bank. Some of those savings rates, depending on where you bank, should start to creep up as well, which can be a good thing. But again, the number one thing is battling inflation. And where do we turn to and how do we combat inflation? Well, it's through investing in equity. And although the market's been unkind to us so far, we know at some point equity is going to be the great driver going forward. So it's still the same story of stay calm, stay invested, at least for now, as we see some things start to shake out. And we think we're still nicely poised here in at least the U.S. To maintain some of the great economic activity that the U.S. companies have had. So I hope this video is helpful. If you can, please give it a like. Please share with your friends. Really trying to grow the channel. If you got any questions, comments, or concerns, please let us know. And as always, have a great rest of your week, and we can talk to you guys soon.